Is the president slamming real estate investors? I mean, should you even invest in real estate under President Biden? Well, let's take a look at 1, his pending tax plan, along with 2, his newest proposal to enforce that plan, and 3, the impact it will have on investors, and 4, alternative investing strategies that you can use to win, regardless of what happens. And then you'll have enough information to decide your next steps. Let's go. Hi, my name is Matt Theriault, CEO of Epic Real Estate, where we show people how to invest in real estate so they can escape the daily grind and retire early. But based on President Biden's new tax plan, it's that early part that's under attack. Now, who you voted for, completely irrelevant. I mean, if you voted for Biden, congrats. If you didn't, you'll get him next time. What's important right now is that you remove your emotions from what's happening. Focus on what's actually happening so you can direct your attention to what you want to have happen. Because whenever there's a change in an administration, we typically get a new set of rules to follow. And we merely have to make some modifications of how we play the game. Simple as that. You know, the game doesn't care how you feel about it, just what you do about it. So there are 3 significant changes to the tax code President Biden is proposing that you've likely heard about already. So I'm gonna go over those really quickly, but it's the 4th and the 5th proposals that most are completely overlooking, yet they stand to cause the most damage. And not only to real estate investors, but our way of life as we know it. Tax proposal number 1. President Biden is proposing to raise the top tax rate on long-term capital gains from 20% to 39.6%. The tax hike would apply to households making more than $1 million. This would significantly impact most real estate investors looking to sell their properties after more than a year of holding them. Yet there's something specific that you can do to avoid all capital gains tax. And I'll show you that in a minute. But they are hip to this. And that's what makes the next 2 proposals critical. Tax proposal number 2. Biden campaigned on a promise to not raise taxes on middle-class Americans. But a little-known provision tucked away in the American Families Plan could do just that. This seemingly small revision to the stepped-up basis could cause average Americans to pay a lot more to Uncle Sam when inheriting assets. Currently, if you inherit a capital asset that increased in value when the person who died owned it, the asset's basis is increased to the property's fair market value at the date of the previous owner's death. This adjustment is called a step up in basis. The increase in basis also means that the person who inherits the property can sell it immediately without paying any capital gains tax because there is technically no gain at that point to tax. This would devastate investors' plans for using real estate to build their generational wealth. While the American Families Plan is light on details, the plan calls for an end to the effects of a stepped-up basis for gains of $1 million or more, $2 million or more for a married couple. Tax proposal number 3 is where Biden is taking aim directly at real estate investors by abolishing the right to defer tax payments on property investment gains of over $500,000. Known as like-kind or 1031 exchange, this real estate investor perk in the tax code allows property investors to roll the proceeds of real estate sales into future purchases without paying capital gain taxes on profits. Since the investor isn't taking any actual profit off the table, but rather just rolling it into another property, it makes sense. This deferral process can theoretically continue indefinitely until the investor's death. And if assets are passed to an heir, the capital gains tax bill is often wiped out by the stepped up basis, of which we discussed will be nixed in this plan. These 2 proposals create a huge windfall for the government at the expense of your family's legacy. This provision to the 1031 exchange applies exclusively to real estate investors, and that includes large investors and small landlords alike, not just the wealthy as this and the other proposals were promised to address. All right, so over the last few months, if you are an investor of any sort, these 3 have become rather common knowledge amongst the amount of coverage that they've received from, talk radio and TV and right here on YouTube. But with all that coverage, there's been almost no mention of what there is that you can do about it. I mean, do you just stand by and take it? No, there's plenty you can do. In fact, it's imperative that you indeed do something. And I'll get to that in just a second. The latest development, however, is tax proposal number 4. Biden's IRS enforcement measures are cracking down on small businesses and income property owners. And that's really unfortunate. This is where his sights are aimed, considering it's on the backs of small business owners and real estate investors that this country was built. I've got a feeling he won't end up on the right side of history for this one. But nonetheless, they are the target of Team Biden as the administration looks for ways to fund his roughly $4 trillion in long-term economic proposals. The White House detailed in a report last week the administration's proposed measures to raise $700 billion in additional revenue over the next decade through Internal Revenue Service enforcement. The administration called for deeper access to your bank account and to upgrade its information technology system with artificial intelligence to more closely monitor your account. The Treasury's plan also includes requiring banks and financial institutions to report your account flows, information that the IRS currently doesn't have. The IRS will now be watching every dollar that flows into your account, the source of those dollars, and then track how every dollar you spend is spent. Further, the president is aiming to double the IRS staff by building a small army of new tax auditors. This government overreach will not be limited to just the wealthy either. It will include everybody. Big Brother is getting bigger and much more intrusive. Tax proposal number 5 will not necessarily be proposed, but rather imposed. And I'm referring to the silent tax of inflation. This is the decline of purchasing power of a given currency over time. It happens typically by one of two forces, the printing of money or supply shock. And right now, they're both happening simultaneously. First, consider the pandemic and economic stimulus programs. You can't just print trillions of dollars without consequence. And second, consider the global commodity shortage in everything from lumber to your favorite Chick-fil-A secret sauce. They've tried to keep this one quiet, but it's now all showing up in the official numbers, as inflation in April appreciated at its fastest pace in more than 12 years. The Consumer Price Index, which measures a basket of goods as well as energy and housing costs, rose 4.2% from a year earlier. That's what the official numbers say. But what really matters is what you're actually seeing and spending. For example, my wife's $4 Starbucks latte a year ago now sits at $5. That's more like a 22% real world increase, meaning her dollar just 1 year ago today is worth 78 cents. In a MarketWatch interview last September, hedge fund billionaire Ray Dalio warned investors to watch the value of their dollar as closely as they watch the value of their investments. Love him or hate him, he's hit the nail precisely on the head with this piece of advice. Now, inflation can be viewed positively or negatively depending on the individual viewpoint and rate of change. Ideally, an optimum level of inflation is required to promote spending to a certain extent instead of saving, thereby nurturing economic growth. However, when inflation exceeds optimum levels, drastic measures can be required to save yourself. It's not just my wife's cup of coffee that's more expensive. Building supplies, food, energy, they're all increasing in price and at a much more rapid rate than the 4.2% consumer price index suggests. All you gotta do is just compare your receipts today from a year ago, and you'll see. And this is a real problem for wage earners, as wages will not keep up with inflation. Additional losers in such an inflationary type environment are the savers, retirees living on fixed incomes, borrowers on variable rates, and exporters as they become less competitive. And the economy overall can lose big due to the uncertainty high inflation can create. Should you be scared? No. But you absolutely must take action to save yourself. What you do next matters. Because there are also winners in an inflationary environment. Owners of hard assets. If they're income producing assets, even better. And debtors on fixed payments also win. For example, inflation impacts assets positively by way of appreciating their value. And as inflation attacks the value of your dollar, it also thankfully attacks the debt you may have used to purchase those assets. This is where real estate investors who use long-term fixed rate loans to buy income property win in a very big way. And so here are 5 specific actions you can take to maximize your position and win even bigger as inflation persists and rises. 1, embrace the velocity of money. Now, I just made a very detailed video on this that I'll put right up here for you to watch later. But essentially what this means is you want to leverage the equity and income of your assets to buy more assets. Number 2, leverage OPM, other people's money, like from banks and credit cards and private money and sellers themselves, to buy your assets. You know, Dave Ramsey may not like debt, but in an inflationary environment, long-term fixed debt is a far bigger asset than owning your own home free and clear. Playing it safe by eliminating debt and saving your money is a losing proposition as inflation is taking off. My grandparents are rolling over in their graves right now listening to me say this. But things are different now than when they were alive. And so a different strategy is required. Number 3, buy real estate for income. Focus less on the real estate's price and potential appreciation and more on the income it produces. I mean, the appreciation has long been your hedge against inflation. That's a given. It's going to happen. But it's your ability to raise rents in accordance with inflation that will have you navigate this new environment unscathed. Number 4, leverage the 1031 exchange while you can. I mean, if you're looking to upgrade any of your properties, best to do it right now while the market is hot and you can still take advantage of this section of the tax code. Should the 1031 exchange indeed disappear, then instead of selling your properties to upgrade to new properties, you're gonna wanna start considering refinancing your properties to pull the cash out to then buy new properties. That's gonna be the strategy. As you can use that cash out tax-free because it's a loan, and a loan is not classified as taxable income. So you keep refinancing, pulling the cash out, and buying new income-producing assets. As my good friend Jason Hartman says, refi till you die. Number 5, buy more income producing assets, whether it be real estate or businesses, and be sure to use debt for those purchases. You do not want to be holding on to a lot of cash as inflation rises. Your wealth will shrink if you do. Per the latest Consumer Price Index numbers, you've already lost 4.2% of your cash wealth in the last 12 months. If you refer to your Starbucks coffee index, it's more like 22% of your cash wealth that has been lost. So the main question, should you invest in real estate under President Biden? Well, I'm not sure you have too many other options than income producing real estate if you want to come out the other end of these tax proposals better off than you are right now. And so with that said, you'll likely have to make all or some of the modifications to your investing strategy that I just laid out for you to do it. And there's even more that you can do to protect your wallet from inflation. That wasn't everything. And I'm putting that game plan together for you right now. So make sure that you click the subscribe button and ring the bell so you can get notified as soon as that goes live. So what are your thoughts? What did you find most valuable? Let me know below. And who do you know that needs to see this? When their name comes to mind, please share with them. Oh, and if you are already subscribed, I pulled this video out special for you to watch next. Otherwise, I'll see you next time. Thanks for watching. Take care.